Hello, hello, hello. Welcome, 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 everyone. It's another beautiful Tuesday in the neighborhood, so to speak. We've got an interesting interesting setup here happening in the morning. If you were watching earlier, everything was positive, and we'll go over that and what that actually means. My name is Victor Jones. You're listening to the Options Hour. For the next hour, we are going to be covering the markets with a spin on derivatives. That's what we like to do here. And obviously, if you've listened before, thanks for tuning in again. If it's your first time, there's a lot to cover because the market here sitting at 1371. If you remember, we took out that number yesterday before settling back below that number. And when I quote 1371, that's the S&P 500. It's the futures contract specifically that I'm quoting, and why that's so important is 1371 was the highest point that we've seen since 2008. So essentially over almost 3.5 years, we are now approaching what you saw as we entered kind of the subprime mortgage meltdown and everything else through 2007 when you saw oil prices hitting $150 and drastically changing consumer behavior and therefore changing the price of all the other commodities out there, wheat, grain, and everything else. So from 2007 to 2008, when you saw volatility, 45, 46%, and then, at heights of around 90% in terms of the VIX, we're seeing kind of an interesting return to those levels. So 1371 is where we're sitting, up $3.75 in the S&P 500. But here's what's really interesting. You've got the Dow at 12,997, up $28 on the day. Probably a little bit lighter than what you might expect. You might expect us another up another $7-8 in terms of where the S&P 500 is, but really close. I mean, but why are we sitting here at this level, a little bit lighter than the 1371 number expressed in the S&P 500? Well, 13,000 is a big psychological number. That 13,000 number in the Dow, you've probably seen it on, all the different financial news networks and radio shows and everything else that you listen to out there. 13,000 is one of those big numbers, and I think it's definitely something to take note. I think the 1371 number in terms of the S&P 500, there's a reason why 1371 is being that high point and a very interesting resistance level in 2008 kind of corresponds to the 13,000 number in the Dow. You've got the Russell. We're up on the Russell, 826.60, up $1.10. The Nasdaq, 2,628, up $20 on the day. Now, here's what's interesting. You've got the VIX at 1797. As I mentioned, if you listened yesterday, 35 minutes past 4 on Central Time and about 5:35 Eastern Time, we had an interesting conversation with Tom, and the VIX was up 5% at the end of yesterday. Now, for those of you, if the VIX, if that's a new term for you, the VIX is a measure of the S&P 500 options. Essentially, it measures the option premium. And what that essentially tells you, if you have a VIX of 18, that's expressed in percentage terms. That means 18%. So essentially, the market over 1 year expects about an 8 plus or minus. Again, it's just magnitude of move, not direction, but plus or minus 18% magnitude of move given the current information, the current pricing of these options. So a little under 20% move from where we are today at this 1371 level is what that's telling you. And the higher that goes, the more uncertainty about the distribution of prices, and essentially the more fear there is in the marketplace. So you are seeing a bit of a retracement here from the 5% move up yesterday, but it's not equal to the move to the upside. I think there's a little bit of nervousness. And again, if you were watching earlier this morning, right after the open, you saw the S&P 500 up, the Dow up. So essentially, you saw equities up. You saw the VIX was positive, which is it typically has an inverse relationship with the overall market. If the market is moving higher, well, there's less nervousness, there's less fear in the marketplace. You see a VIX or volatility index that tends to contract, and then as the market sells off a bit, the equities market, you see a number that tends to expand. So that number is important, and if you see, it typically has an inverse correlation, and we saw a positive VIX, which meant as the market was moving higher, hitting these highs, the market was nervous, and they were buying a little bit of premium. They were buying protection. We're going to talk about buying protection and protecting the portfolio just a little bit by using, obviously, options. But, it was interesting. You saw VIX positive. You saw the dollar positive. You saw gold positive. You saw crude positive. You saw strength in the dollar at the same time you're seeing strength in commodities. And you also saw the bonds. Bonds were actually positive as well. And you typically, it's very rare that you see a direct correlation or all those things moving in the same direction. There's some inverse correlation there that happens between those instruments. If you're seeing the equities market get stronger, you might see money coming out of fixed income and vice versa, or same thing happening with the dollar. As the dollar gets stronger, you might see money coming out of commodities, as that makes those commodities a little bit more expensive, but a little cheaper. So it was an interesting kind of setup this morning with what was happening in the marketplace, and obviously some of those things broke down. You saw the VIX come off just a little bit. You saw the dollar get a little bit weaker, and commodities are sitting where they are. And as we mentioned commodities, as we mentioned the metals really quickly, and energy, because that's something we've been tracking here over, I don't know, maybe the last 2 months or so. But crude oil, $17.89. $1,789.90, up $15 on the day, and we're approaching that ever important 1,800 number. And why I say ever important, if you can remember what happened last time we approached 1,800, we saw basically once we saw 1,800 about 3 expiration cycles ago. You saw a quick retracement down to about the 1,680 level. Before a little bit of buying pressure came in and basically took out the floor. We hit 1,550 again. Now you've seen gold move from 1,550 up to 1,800. We're going to talk just a little bit about where that play is and how we can position not only gold, but obviously what's happening here in crude as well. Now, if you've been watching crude the last 2 days, something is coming out of that crude market. You're seeing a lot of risk premium there. Some people, the reports are obviously a little bit of nervousness with what's happening in Iran. And with the nervousness, the uncertainty there, you're seeing risk premium built into crude. I mean, there's no doubt about it. We essentially saw this oscillation in pricing, from basically 95, I'll call it. It was really 98 was really the trading range, but 95 at the lower end to about 103 on the upside. And for about 2.5 expiration cycles, that was a very interesting range. Obviously, you can't be range bound forever, but when you do get 2 to 3 expiration cycles where it allows for an interesting strategy, that 98 103 range was a very interesting one for about almost 3 expiration cycles. And you've essentially seen, you almost saw, I want to say it was something like 20 straight trading sessions in a row, or somewhere around there, maybe 15 sessions in a row with positive movement in crude oil. Until we hit 110, and so basically yesterday you had a pretty big retracement in crude. We backed off about $2, and now you're seeing we're down slightly. We're down about 40 cents or so in the crude market, but here up at 108. I was reading an interesting article here yesterday that basically said an analyst came out and said, there's so much risk premium built in here, and I have to agree. And obviously, if you've been watching it here, I mean, the dollar isn't telling us crude should be here. The inventory levels aren't really telling us crude should be here. But, if we come out, let's say Thursday or something, we get these inventories, or maybe just over the next few weeks, the next month or so, you see these inventory levels, and because they start to indicate, hey, regardless of risk premium here, we've got inventories building. You could easily see a nice, I don't want to say nice, an interesting retracement there as we return to, or kind of the market gives up some of the risk premium to account for those building inventories. So at some point you have to see, inventories have to match up with what's happening in terms of pricing action. So, we're going to be watching this 110 level very difficult to play this here because, I mean, essentially if the worst does not happen, you might have an interesting retracement. But, it's one of those things where we're not trading, economics right now. We're not trading, necessarily the price of crude oil versus, what's happening with dollar, what's happening with coal and all these other commodities. You're essentially, you've got this risk premium built in, and you really have to account for it. And it's a bit of a wild card in the crude market right now. But interestingly enough, again, we're trading here. We just backed off the 110 level. We're at 108.04, down about 50 cents. That's 0.5% on the day. So we're going to circle back, and everything we quote. Obviously, we're going to go back and talk, some strategies there. Well, we just want to kind of set the table, so to speak, with what's happening here in the market. And every time I like to do the market wrap up, we talk about the overall market, we talk about a few commodities, and we talk about the VIX. And I think it's pretty much a habit now. After we talk about those things, I mean, it's difficult to talk about the overall market without mentioning what's happening in Apple. I mean, Apple is such a driving force in what's happening here, at least on the tech side. I mean, at least on the tech side. And you've seen, again, we know the story here. We're sitting at that 420 level into earnings, expecting 30 million of those iPhones to be shipped last quarter, and they came out 37 million units have been shipped with 13 million iPads behind it. And so you saw a $25 gap, and from there it was sky's the limit. So since 450, we're now seeing 533.20. Apple traded up to 533.20 today, which is, as you may have guessed, a 52-week high. So we're sitting here now at 532.08, a little bit over a dollar under the high that was made a little bit earlier, but 533.20, and you're wondering to yourself, how is this, where does this stall out? Where does the move stall out a little bit? And here's what's interesting, is that you have, and we talked about this a couple of weeks ago, because those things, it was unconfirmed on the rumor mill that somewhere around March 7th or so, Apple would come out and announce, the iPad 3. And so essentially here this morning you're seeing, and over the last couple of days, you're seeing a little bit more of that confirmation in terms of what's going to happen there. And what's happening with those. I mean, I'm just pulling up an article here right now, and the first thing you see, it's talking about what's going to happen here with the iPad 3. So, I think it's going to be very interesting, but if Apple has proven one thing, or the market in Apple, I don't want to say proven, but there's been a sort of a pattern that's, it's kind of a buy the expectation and sell. When sell the news, it's kind of like a buy the rumor, sell the news type thing. But in Apple, it's less rumor, right? Because it's we have, before it was, we have a new iPhone coming out, and you saw the market rally from 400 to 420, and the market found out, hey, it's iPhone 4S, not iPhone 5, and so the market sold off immediately from that, and then the numbers came out with pre-sale orders, and we rallied again. So what you're seeing here in the Apple market, I think it will be a little bit difficult to bet against them going into the announcement. Again, if you're looking, you can even see it in the news if you're utilizing the ThinkorSwim platform. Apple on Tuesday sent media invites to a special event to be held March 7th in San Francisco. The event read, "We have something you really have to see and touch." So I mean, they're trying to give out as many clues as possible without really saying it here. But again, next week, March 7th, as those rumors that we talked about 2 weeks ago kind of are now confirming, Apple shares are up about $6 today, about 1.125%. But those are the invites that they sent out. And, March 7th, I think a lot of people, depending on that form factor, it's kind of one of those things. I think it's difficult to bet against them going into March 7th. And then, we'll see if the market really holds up this rally, or now that, the news actually comes out, that they give into some of that. So I also wanted to talk about a few other techs here today, and feel free to give us a call. I mean, feel free to give us a call on the show, and we'll essentially, go through in not only techs. I think the market here at 1370 is an interesting high point. And people are worried about risks. They're worried about their portfolio. They're looking about ways to potentially protect profits a bit. And, feel free to give us a call if there's any position in particular that you want to talk about. Now, here's what I found was, I just want to give an alert to everyone out there, because if you're listening to this show, either you're interested in options or interested in strategy using on your portfolio, but I think it's always important to give some alerts out there. Let's keep everyone informed with what's happening. I think in TXN, Texas Instruments this morning, Texas Instruments trading 33.73, and this is one of those securities that's it's at 28% volatility. It's not going to, it's almost like another Microsoft, so to speak. So we've essentially been range bound between 26 and 32. We made a new range here at 32 at 34. And this morning, when basically we've hit the high of the day around 9:30, maybe around 9:20, 9:25. What happened here in Texas Instruments is about 3,000 calls were traded on the 34 strike in April. So the market now 116 at 118. The market then, the theoretical price was somewhere around 118, and it looks like someone hit the bid. So the market was pretty similar to where we are today. It might have been 117 by 119, a penny higher on both sides. And the theoretical price at that point was 118. Someone came in, a block trade, 3,000 contracts, a little over, traded at just below the theoretical price at 118. Here's why that's important. There's different ways to interpret that, and it's going to be difficult for us to look at anything like that and say this is basically what's happening. But when you see something that occurs below the theoretical value, sometimes you make the argument that looks like a sell, right? The market's not going to sell anything to anyone out there for under theoretical value. And so you make that inference and you say, okay, what's really, really happening here? Well, you might have someone that's long those underlying shares, right? And as the market rallied and as we came close to 34, and I'll show kind of a 5-minute chart if you're actually watching here, as we came to 33.84, it was actually right around those highs. Someone came in and sold those 34 calls. You could say we sold off just a little bit from there, but I think that was an interesting tell. It's an interesting tell there that you see. At the same time, look what you saw basically at that 929, 9 level. You saw someone come in and had significant buying right around 9, and then right around the highs at 33.84, you saw someone selling 3,000 calls. So, and you saw, I think that's interesting, and that tells you just a little bit about where those upside resistance points are, at least from some large institutional player out there. So if I'm looking at this and I'm thinking to myself, how can I, some institutional money made a play here. What's the play behind it? Again, if you're long Texas Instruments, it might be an interesting point to go ahead and look at potentially covered calls. If I'm long here, could it be interesting to go in and sell that 34 call for April or the 35 call for April if I want to be less conservative? And basically what that means is if the stock goes higher than 34, if it expires above 34, you'll be obligated or you'll be called away from that stock. So you sell one call that controls 100 shares. So if I'm long 100 shares, I sell one call. If we expire above 34, I'll be called away from the stock, 115 at 117. So they'll call it away at 34. As long as I've paid less than 34, that's fine for me. Essentially, that's a limit order to sell at 34. And if we're sitting here at 33.73, I'm thinking to myself, at 34 would be an interesting exit point. Well, selling a covered call is essentially getting paid for that exit point, assuming you stay higher than 34. You'll bring in about $1.18 to do that. Why is that important? Well, even if you get called away at 34, you got to factor in that you're going to get paid a little bit over $1. Let's call it $1.20 to actually sell the call, effectively making your selling price $35.20. Now, if Texas Instruments just sits where it's at and does not move above 34, you'll get to keep the $1.20. And if it does pull back just a little bit, now think of it, 33.73, 10% is about a $3 move. So about $1.50 is a 5% move. Essentially, you're covered for about a 5% down move from where we are today. So if you're thinking 34 is getting a little bit top heavy, but you're not sure you want to get out of the position, here's the thinking behind this. We're getting a little bit top heavy at 34. Maybe that's your trade assumption. And all trades start with a trade assumption. So I'm just coming up with several ones here, more so to talk about the strategy. But at Texas Instruments, again, at 33.73, it's made a couple runs to 34 and it's backed off before. So if the thinking is that, maybe at 34 we'll back off, and I'd like a little bit of downside protection. And selling the 34 call, you would get about a little less than 5%, maybe around 4% downside protection from where we are today, which is an interesting amount of protection, especially considering that the range before, remember we looked at this and we saw it was a little bit range bound. The range before is really 32 was that previous resistance area. So backing off from 33.73 would put you, around 4 cents or so, would put you right around 32, which means you'd protect yourself from a downside move to what would be expected resistance or short-term resistance at the 32 level area. So if you're looking at, that's the strategy behind this, and I wanted to point that out not only for a couple of reasons. One, we get the chance to talk about covered calls. Or buy rights. If you don't have Texas Instruments, it's possible you could just buy it and simultaneously sell the 34 call to put yourself in a strategy. But we talk a little bit about what people are doing here. I think showing that someone's coming in and selling 34, 3,000 of these calls at the 34 strike. Thinking through why that could be and what the market's doing here. And again, that may not be an institutional player that's any smarter than any one of us. They're just maybe a little bit more money, larger position size. But at the end of the day, money moves the market just a little bit. So if the market sees, hey, 3,000 of these things are trading or going, selling at 34, there's a little bit of reaction. You can see whether it's related or not, the market's waffled since that point as well. I mean, that was a high point of the market. Texas Instruments has backed off just a little bit. So I wanted to note that as we go in. We'll talk about a few other names. I want to talk about Amazon here, because I think Amazon is important. If you notice, if you listen to the show, we have a little bit of a tech bias. We talk about commodities, we talk about the overall market, but when we go into individual securities, we do have a little bit of a tech bias. And I think, we're a technology firm here at ThinkorSwim. We build trading technology. We're traders at the same time. But these techs, they're interesting. And, not only that, but, finance has been interesting here as you deal with the European debt crisis, quote unquote. So we'll talk about a few of those names we've been watching, one of which being Bank of America. You saw Bank of America as we started trading or looking at it right around 6. It's made a move up to $8, and that was a really nice trade. We'll look at Amazon here. If you look at Amazon, we're trading right around 182.33. And I like to look at this because it's an interesting, I think, short-term support area for Amazon. I mean, if you just look at the chart, from a technical perspective, and you look at, what Amazon has done for the last year, you've seen highs up to 250, and you've basically seen this kind of basing area right around the 180, I'll call it 175-ish area. And I think that's important because Amazon quite frankly didn't have a great quarter, and the market reflected that. And you saw a sell-off to 170, and I think people were expecting a little bit more out of the Kindle Fire in the holidays, and they actually, as Apple proved, they moved 13 million units of the premium tablet versus what Amazon was able to do with the Fire. But at the end of the day, you have to realize that their money is not coming from the Fire, right? So to speak. It's coming from ads, it's coming from revenue, it's coming from getting those people into their store, it's coming from commissions there. So it'll be interesting here, but I think you saw usually the market tends to knee-jerk in one direction or the other. And so you saw a knee-jerk reaction down to 170. And so I think it'll be interesting to see here, without any other catalyst, whether or not you see a little bit of a basing here in Amazon. Even if the market turns around here, I think it's tough. It might be tough for Amazon to go lower than where we are today. I mean, obviously it's not a recommendation. I just think here it's tested this 170, 175 level basically over the last 2 months, and it's held it. So I think if we look at that, we make that trade assumption, and you could make that assumption. You could make it on the opposite, that hey, I think the market's overpriced here, and we could see a turnaround. But I think right here at 182 where we're trading today, if you just look at what the options, the potential, the options are giving you. If you look at the 170s, the 170 puts, 170, 165 put spread is giving you $1.05. So if you're someone that's looking at this market and you're saying, this is interesting kind of basing pattern, I wonder what the opportunity may be here. Well, we're trading at 182, so this is $12 lower, probably 7% cushion or so from where the current market is. Really, when you factor in the premium that you're going to get, it's somewhere around 8 to 9% cushion. And essentially, in selling the 170 and buying the 165 put, and we're looking in April. And why are we looking in April? Well, there's about 3 to 4, typically when we're looking at selling premium, we're looking for 3 to 4 weeks out. It's difficult to look at selling premium in March because you only have 17 days. Essentially, you have a little bit less room to play. You're going to have to select strikes that are very close to the market. And we're typically looking to exit these positions 3 to 4 days, 4 to 10 days to expiration. So getting into a position with only 17 days to expiration doesn't make a lot of sense to us unless it's an extremely short-term play. We play weeklies all the time, but I think this one, again, with Amazon, is a little bit more conservative, so you want a little bit of time to make it work for you. So at 170, 165 put spread in April, you take in $1.08, which means you've got $4 basically of risk, we'll call it, just to make it easy. So you got $4 of actual risk there. So essentially you got about 80% probability of success in that particular spread. So I think, it's an interesting kind of play there with Amazon. It's been basing here at this 170, 175 level. And, it's trading right around $1.10, about $1.10 in credit. So it's something we'd kind of looked at, and I think we'll look at it long term here. But I think if you were looking at, hey, I want a longer term, or I want a bullish play, and maybe I'll mix that up with a bearish play. This is one that's a little bit interesting. Now, in the same realm, right? In the same realm, I want to take us back to the charts here, and let's look at Netflix. Netflix is interesting. Here at 114, it's moved off. It's had a significant move from those 62 levels that we saw just 3 months ago to about 130. It's now trading 115, about 114.10. Now, what's interesting here is that they've just announced that they're going to head into a partnership to basically try to take advantage of the 50 million Spanish-speaking market out there that they see with Univision. If you know Univision, it's a Spanish broadcasting company, and this could be a very, very interesting move. Again, Amazon, HBO, all these different companies are heightening kind of their digital streaming competition. So even though, again, you saw a knee-jerk Netflix reaction on Netflix, which sent it down to the 62 level, it repriced itself right around 80, which was probably more like its true valuation at the time. And into earnings, you saw a significant rise all the way up to 130. Now some interesting news. They also announced a new partnership with the Weinstein Company that they would be able to provide some of their content within an hour of release to the movie. So they're significantly increasing their catalog, or they're being very aggressive about increasing their catalog. And you're seeing it pay off on a day like today. Again, 114.27 is where Netflix is now currently trading. Again, 114.27. That's up about 4.5%. So we are right at about 110 at the beginning of the day. So it's up $4.82. Just about 4.5%. Very interesting move there from Netflix, and exhibiting a little bit of fundamental strength. I think it's interesting as well from a price action perspective, because the market, if you remember, we gapped up. Where did we gap up from? From about $93 up to 111 or so. And you saw a little bit of a penetration into that gap here over the last couple of trading sessions. And now you're seeing a significant move or some buying pressure here with fundamental information that's going to bring us back above that island, so to speak, up there at that 110 level. And it's important because it is a significant number. 110 is a significant number because that's where we gapped down from one earnings cycle ago. And just, speaking of earnings, guys, we're out of basically that fourth quarter, that fiscal fourth quarter, or calendar fourth quarter earnings cycle. I mean, we've essentially had, I think, 468 of the 500 S&P 500 companies have reported. So we're really at the tail end of earnings season here. There's a couple yet to report, but now it's kind of it's going to be interesting to see how we play out. So even though earnings is over, we're still at a very significant level here at 1370, which I think is going to paint the picture for essentially where a lot of where we're going to head here. If we can hold this 1371 level, or if we're running out of steam here, and again, 1370 over 3 trading sessions, you've essentially seen almost little to no movement. We're really stuck here. So, I think if we don't have some buyers come in and take the market higher here, I think you have the potential for a bit of a correction. Now, we've talked about the heavy hitters so far, Apple and Amazon. We've talked about Netflix and Texas Instruments as well. We want to bring it back to the overall market here. Let's really bring it back to just SPY, and that's the S&P 500, which tracks, it's an ETF that's 1 for 10, the SPX, or the S&P 500. We're trading here at 137.46. So if you thought 1,300 was a significant number just, 5 or 6 weeks ago, we're now knocking at the door of 140. And why I think that's important, if you're long here, if you were net long, and I'm talking about your entire portfolio, I'm not just talking about an individual security or maybe you're trading SPY, I'm talking about net long. If you are net long, I think there's some interesting opportunities here when we look at SPDR, when we look at the S&P 500. And why do I say that? Well, if you remember before, I just said something. Oh, now I'm going to go in the face of what I just said. If you look at March, it has 17 days to expiration. The 140 call, 140, 141 is trading basically right around 22, 23 cents. So it's one strike wide, 22 to 23 cents. So you basically have a 77 to 78% chance of success in selling the 140 call and buying the 141 call behind it. Why is that important? Well, you've seen this significant run over 5 to 6 weeks, almost 100 S&P points. If we continue that run, then great. But it could be here at this 1371 level. Maybe not here. Maybe we push forward another 20, 25 points. At what point do you feel that it would be healthy for the market to have a correction? I'm not just talking about a correction that brings us down to 1150 or something. I'm talking about a healthy market retracement that allows us to move even yet higher. So at what point does that actually happen? And I think within the next 17 days, if the market were to rally significantly and surpassed 140 to 141, it would be interesting. It would be a little bit surprising, quite frankly. And if you look at the probabilities here, even the market is pricing the 140, 141 call spread as if there's a 77% chance that does not occur. But that allows you to potentially make $23, $25 on every one time you do this. So you're doing that, let's say you do that 10 times, that's $750 of risk to potentially make $250. So you're taking on a little bit of risk there, but at the end of the day, if you're net long, remember this, if you're net long, this is just simply a short-term hedge. This might be a losing trade in the short term, but it was essentially a way to bring in $250 as a short-term hedge, and maybe you end up, we do rally significantly above that, but your overall portfolio should be weighted such that you're still profitable. Maybe you only do this a couple of times, so that essentially, if we do pull back, you'll be profitable on a spread like this. Again, not a recommendation. I'm just throwing out. We're just talking trade ideas and different strategies here. But if the idea is to hedge the whole entire portfolio, instead of going into each individual security and potentially selling calls or selling call spreads, there's the opportunity here to just look at the overall market and say, hey, can I position myself to say, if we pull back, I'll be profitable in this trade, which should help offset some of the losses elsewhere. And in doing so, I think, a hedge like that right around significant resistance levels isn't the worst idea. I mean, you saw it in the Texas Instruments market this morning. You saw someone come in at a 34 level and sell those 34 calls, thinking that that could be an interesting place to take some premium. So I think this is that same mentality, that same strategy, but you're applying it on the overall market. Well, why are you doing it in March with 17 days expiration versus, in April? Well, again, it's all about timing here. Okay, the market has rallied significantly over the last, 4 or 5 weeks. Let's call it 5 weeks, from 1,300 level up to nearing the 1,400 level. And where you would be selling, where this trade is basically going short, is the 1,400 level. So in 17 days, for us to get there and surpass that level could potentially be looked at as maybe an unhealthy move, or a move that needs some healthy retracement. Over the next 52 days, which is the April expiration cycle, well, that's 52 days. That's significantly much more time. That's enough time for us to rally a bit, have a correction, and then rally straight through the 140, 141. Which isn't a bad thing as long as you're willing to potentially exit the trade early and you have that feel for the market. But if this is maybe the first time that you're looking at this, or potentially hedging the portfolio, or whatever the case may be, I think with 17 days to expiration, that one gives you the time that you need to be right, but at the end of the day, you want less time here, and it's paying off an interesting amount to hit a 1,400 level within the next couple of days. That said, let's do a quick market wrap-up here. The S&P 500 is trading same level. We lost about 2 ticks here. 1370.50, up $3.25. The Dow here, $12,992. So we've lost about $6 off the Dow, up $24. The Russell, interestingly enough, has turned negative here. The Russell 2000. So the small cap stocks here today are turning negative. We're at 825.10. We're down 40 cents. Remember, that was positive when we first started our talk. So the small caps here have turned negative. The Nasdaq still hanging around $2,629.25, up $21. The VIX here at 1802 again, down 17 cents. It's up. It's basically down, or up 5 cents from where we first quoted it just maybe 30 minutes ago. So you're seeing a little bit of nervousness come into the market there. The small caps have turned negative, and the VIX is returning here. Interestingly enough, gold has retraced just a little bit at the same time, $1,790.80, up $15. Actually, it's about even from where we quoted it before. If not, maybe up a little bit more. Crude sold off just a little bit more. We were down 36 cents before. We're now down 40 cents, 108.18 there in the crude market. I want to quickly take a look at crude, because as we mentioned before, if you're someone out there, and we've got a couple of writers and things like that have written in, sent a few emails, and even the people we talked to on the trade desk, I think there's some people there that are looking at that and saying, if this is risk premium, where's the potential there if this is just a little bit of risk premium? And I think this one for me sets up an interesting calendar. There's an interesting calendar spread here. And let's look at this one here. But it's a little bit difficult. It's I want to say not difficult, a little riskier. But let's look at the actual chart here. On the chart, you see the same action in USL that you essentially see in the crude market. And you've seen a move from about $37 up to the $41 range. So you're saying to yourself, Okay, where is the potential here on a downside move? You know, if the market moves off here in crude, well, what happens? The volatility there would increase just a little bit, right? So you have an increase of volatility and on a downside move. So I think, you know, selling call spread is something you always have the ability to do, but I think we've looked at a few call spreads. So just in order to mix it up, again, it's not a recommendation. We're showing strategy here and how these different strategies work on different underlying instruments. USO trading at 41.30. What's interesting here is this 40.50. Unfortunately, you don't have the 40.50 in the next month, so we'll look at. Actually, we've got to go out to April to show the calendar. We're going to buy the calendar spread here. Just show what it looks like, because we just want to show what this actually looks like. Now, it's 50 cents here. Let's analyze this trade. And all we want to do is set, if you're looking here at the ThinkorSwim software, we're just demonstrating exactly where this market is versus, you know, where it could be depending on the different movement we'll see here. So we've got the current live slice here, which is, let's do set slices to our break even on expiration. We want to add one more slice. So you're saying, if we're looking at USO on the chart, let's look at USO on the chart, and you're saying, you know, the support area, let's just call it for USO, would be the previous resistance area, which is right around 40. Okay, and on a retracement, on a knee-jerk reaction, you might see it move as low as 38, but I think, you know, for this market at 108, you know, that's more than basically if you move off $10, it's a 10% correction. So you're probably looking at a 15% correction in crude, which would, you know, it's not out of the question there, but it's very aggressive. At 41.40 here, I think what's interesting is you have a 41.40. If you were to look at this 40 calendar, call calendar on this side, you can see your max potential profit is right around 40. You know, and for a $50 trade, it has the potential to be worth around $85 or so at expiration if it's at or around $40. But I think what's you know, if you look at where your break-evens are, your break-evens to the upside are 42.47, and to the downside are 37.81. So let's set these slices to the actual charts here. So you can see this is where we just said our support area might be on a knee-jerk reaction. You can kind of see in this particular strategy it's right around 38. And you can see if we were to have a downside move, that's essentially where our downside break-even is. But you got to imagine volatility will increase in a move like that, which would actually extend your break-even a little bit lower to the downside. So I think a calendar here, when you're getting at these kind of overpriced levels where you expect, hey, there's the potential here to have a little bit of a correction, or you have a little bit of risk premium built in, where volatility could quickly increase. And you can see, again, if nothing else, it's a very small trade. It only costs 50 cents to do, which means if you continue to see this run, if you continue to see a move to the upside, with USO or with crude in general, you know, you have the potential there. You know, if you're sizing this appropriately, if you're sizing it very, very small, you have the potential. You know, you're not putting much at risk in something like this. You know, so if you're wrong, you're wrong, and if it stays within that range, basically $42 to $38 range, there's a potential to be profitable depending on what volatility does. And so I would encourage you take a look at that. And we had a couple questions here when we were looking at the spider trade on SPY. And the question was, well, why didn't you use the quarterlies? And, you know, it's a great question. But I think, so if you remember here, we've got April, we've got the March, we've got March weeklies, which expire in about 3 days. We've got March, the regular cycle, and then we've also got March, the quarterlies, which expire in about 31 days. Well, if you remember, Spider actually pays a dividend. They pay a quarterly dividend, and March just happens to be the month where they are going to pay that dividend. So I think you've got to understand the dividend and how that potentially affects your short call spreads. And that's essentially the reason why we did not take a look at that one, just because of what that can potentially mean. I mean, you really have to understand that dividend play. So it's a great question there. So we'll take a quick look. I wanted to look at just one more here that's been kind of a nice mover, but I wanted to look basically at the up and down side. If you're looking at the S&P 100 here, you can see we talked about Amazon, we talked about Texas Instruments. Both of those are having significant upside moves today. But I think we'll come in and we want to just talk about there's two others here. There's EMC, which is having they're down about 1.5% on the day. So I'll quickly bring up EMC for everyone out there. We're up, basically we're trading at $28 today. It's had, along with the market, since its last earnings cycle, a significant upside move from around $23, and it's traded $5 higher, up to $28. You're seeing, you kind of saw this range here, 26. You kind of saw it base out at 26, and now it's trading as high as 28. I think it's interesting to look at things like this on a significant move like this. I want to show what happens because you have about 28% volatility here, which is pretty expected, I think, for a stock moving in the same range that it is. So what I'll do here is actually sell the 29 call spread. We're going to sell the 29 call spread. We'll move down here, and we're going to buy the 30 call spread. So essentially we've created a short call spread at the 29 level. That's $1 higher. And then if you look at this market, you could look at the, let's say, the 25 the 25 call and the 25 put and the 24 put behind it. Putting those together, you get an iron condor. Again, those legs were all in April. It was the 29 call, short the 29 call, long the 30, short the 25 put, long the 24 put. Together, they're trading for about 40 cents. And 40 cents on a $1 wide iron condor, that gives you about a 60% probability of success. So here's what I'll do here really quickly. We'll set the slices to our break even just so you can see. And again, I'm just picking out different names from the OEX, from the S&P 100 that are having interesting moves today. And the reason I picked this one is because you've got a little bit of increased volatility there. But at 40 cents, you can look at your break evens here. 24.60 on the downside, 29.40 on the upside. Let's look at how that translates. I'm going to hit the set slices to chart. And you can see where our range is. Basically we're positioning ourselves for a little bit of a downside move, but you still have almost $2 to move to the upside. And if it lands anywhere between this range, you have the potential to keep that 40 cents. And that's between now and April. So we've talked about a lot of different strategies here. We've talked about a covered call. We've talked about a buy right, which is essentially a covered call, but you're buying the stock at the same time you're selling the call. We've talked about a calendar spread. We've talked about a short call spread when we looked at the spiders. And now we've looked at a certain situation. We have a little bit lower volatility. You have a stock it's been heavily range bound. I mean, if you look at the way the stock moves over the last 6 months, 22 to 24 was basically its range. And now you've seen it broke out of that range. And now 24 to 28, it's hard to see where that upside might be. We just look at probabilities. It tells us from a probabilistic standpoint, 28, basically 30 would be that upside resistance area, assuming this is the middle of the range. And now we've positioned a trade where our downside comes in almost exactly where that previous resistance was, which in technical analysis, as we know, might prove to be a future support line. And same thing with the upside. So we've taken a look at this particular strategy in particular. We said, hey, there's a potential to make $40 for $60 worth of risk. And if you think, and again, it's not that EMC specifically was the best one to do an iron condor. I mean, these different situations occur all over in all different types of securities, especially in a market now where you're seeing the market's a little bit range-bound. You know, the market is range-bound now, so underlying securities might be a little bit range-bound, so there's the opportunity to look at selling, again, an iron condor. And an iron condor, to go back over that, is when you sell a call spread, an out-of-the-money call spread. It doesn't necessarily need to be out of the money, but typically you'll position these in such a way that you're selling the out-of-the-money call spread, you're selling an out-of-the-money put spread. When both of those are done in the same expiration cycle, that's what's called an iron condor. And so as long as you're doing both of those at points where you have higher probabilities of occurring, you're now changing what may have been, a strategy where you have a little bit more downside bias or upside bias in just selling the call spread or just selling the put spread. If you have no real opinion on where that market might go, but you feel it's been a little bit range-bound here lately and you want to profit on the potential that it's range-bound again going into the future, this is an interesting way to do that, utilizing the iron condor. Calendars do similar. Calendars offer you the opportunity to profit in kind of a range-bound market as you saw. But iron condor is a little bit different, allows you to get a little bit wider, and they're not as heavily dependent on what happens with implied volatility. As we wrap up here, we want to quickly go over the marketplace one more time for you guys as we get out of the show. 1371. So go figure. I mean, we've basically moved in a 50-cent range the entire time. 1371 in the S&P 500, up $3.03. The Dow, 12,998, right where we started at the beginning of the show. So 1 hour and not one penny move. Just kidding. We did move just a little bit, in between there. So 12,998, up $29. The Russell has again flipped positive and it's flipped in a significant fashion. The Russell now trading 826.70, up $1.20. So we were down 10 cents at one point. Now we're up $1.30. And I'm guessing the VIX has backed off significantly, and it has. The 5 cents that it gained, it has just lost again, 17.96. So I want to thank everyone for joining for this hour of this week of the Options Hour. I've been Victor Jones. Hopefully we'll see you again, same time, same place next week. Thanks, everyone.